Hello, audience. It's great to have you back. And I'm also very happy to welcome Dave Nangle of VEF VC back. VEF VC is their website, but they are not the typical VC. We already discussed this in the last interview. You can find above here. It's great to have you back, Dave.
Hey, thanks, Tillman. Great to be back.
It is very nice to do our interview after 1 year because a lot of dynamics in the markets have changed, and we really have a different situation at the moment. We already talked about this in our pre-talk. And at the beginning of our interview, I want to try to figure out a bit the dynamics between public and private markets. So Dave, in your position at VEF, you have a lot of insights into private markets as a long-term oriented VC investor in different emerging markets with the fintech space. So what could you observe in these markets? What are especially hot markets with a lot of competition, and which markets don't have that much competition?
More and less competitiveness in the private markets within fintech across emerging markets. Look, I wouldn't say it's a natural kind of consistency across the board. Generally, I see in emerging markets a lot more by country than by segment over time. So we kind of get countries being hot as opposed to segments themselves being hot. So, and within EM, it's, India first, I think, has always been, at prime, because China obviously is fascinating, big, and a massive opportunity, but then generally China is for the Chinese, is the way most investors see it. So India as a country has always been hot, through cycle. And behind that, not too far behind, I'd say, is Brazil. And then everything else kind of flows in and out of kind of temperature hot, being Mexico, being Southeast Asia. Africa, front and center, gets a lot of focus, more so than other countries on a similar pecking, I would say. Maybe like, the Pakistans of this world or parts of Southeast Asia. Africa always has a lot of dedicated capital, whether it's the ESG side or, financial inclusion money, or just generally speaking, it's very much a focused continent for capital. But I would say that's true cycle. India, Brazil, I would put them top two, and very much a focus. If I was going to drill down to sectors, payments always gets the focus, and it's online, offline, definitely cross-border less so. And then credit kind of comes in and out. But I guess more and more we're seeing a lot of Web3 focus, and is the future of finance in Web3 in various forms of blockchain technology and cryptocurrencies. That's clearly, we've seen the volume turn up there from very focused investors to a more mainstream investor base focusing in that space.
So if you look at hotness, it is also about it also attracts more competition, and this leads to the risk to overpay if there's more competition in a certain space, because there's only a limited amount of great companies. And if a lot of demand for them is around, prices go up. So with your focus in emerging markets and fintech, do you see this happening in a lot of markets, or what do you observe there?
Yeah, look, we're talking today, and we probably would have a different conversation 3 months ago than today. I love emerging markets. I've been in emerging markets all my career, and part of that love affair with them is partly due to a lack of competition. You just get less eyeballs, less capital, less skill set, focusing on what are the biggest part of the world, the fastest growing part of the world, and the most fascinating part of the world. Never linear in nature, but generally going up and to the right gradually over time. And then you get periods over the last 5 to 10 years where we had a good run. We had a good run for, I guess, global stability, global macro, capital flows into the private side, venture funds, private equity. And we started this 7 years ago, and we would have been alone and shopping in Pakistan, for example. You fast track to today, it's busy. And Pakistan gets busy, you start to ask questions, what's happening in the world? No offense to Pakistan. Brazil, back in 2016, at the back end of the last kind of mini recession, we were not alone, but we were one of the few kind of Series B, C investors who were turning up in that market, picking up names like Creditas. Same in Mexico, picking up names like Konfio. And you fast track to 2021, and it got very busy. But then you kind of fast track a little bit to today, and what you're seeing is the start of a risk-off mode globally. Privates taking their lead off publics at last. It took some time, but they got there. So I guess what I'd say is we are a permanent capital vehicle. We're through cycle investors. We're long-term investors. And these aren't cliches. These are facts. We haven't just raised the funds that we have to deploy capital in order to get paid. We cannot invest for a period. We can stop and watch markets for a year, for 2 years. We can not invest in Mexico for 5 years and then do 5 investments in Mexico, should we see fit, if the time is right, if it's a window where political instability, currency blows out, and the opportunity set arises. So I love that flexibility. And last year, over time, we've kind of a checklist of what we're looking for in a company, and we're very rigid and disciplined in that. And we don't get everything we want. We just don't invest. Not saying we can invest, but we want great founders. We want great VCs around that founder. We want traction, strong unit economics, a big addressable TAM, good regulatory support and defendable moats. If we get all that, we dig in and we go deep. But then we're looking for valuation also. And 30%, 30% IRR is our hurdle rate. Now, in fairness, as you alluded to, over the last 12 to 18 months, we started to ask ourselves, are we wrong? Because we were losing deals. We were losing more deals than we did. And we were losing them mainly on valuation, where other people were willing to pay more. So we were saying, we're trying to ask ourselves, are we in the wrong game? Is 20% the new 30%? But then you fast track to today, and the question is 40% the new 30% in a higher risk environment? Is 30% enough to put your dollar to work in an emerging market? So, these cycles come and go, and some are longer in duration than others, but I'm very comfortable that we have a playbook of what we want to find in an investment, what we look for, and when we find out, trying to get our capital in at the right valuation. And even in periods which are, hot and cold, we've generally converted on a regular basis. And found what we want. So, even last year when deals were passing us by for valuation, we still got our capital, into names like Rupeek and the gold-backed lending space in India, into Black Book, and then putting more capital to work in some of our better companies like Creditas and Konfio. And each time we were justifying it with 30% IRRs in Excel on paper with the money we were putting to work. So busier, yes. I expect that volume to turn down. And I kind of expect global capital, which ventured outside of US, Europe, got a bit more aggressive during the pandemic, specifically via Zoom, in markets where it's not their first port of call. That's no offense to them, but getting capital to work out of the US into Nigeria or into Pakistan or investing in Brazil, having never traveled there. I know that's not a sweeping statement, it's isolated incidents. I think that capital starts to go a little bit more risk off. And for people like us, true cycle investors, it's going to be a very interesting next 6 to 12 months. And these are the kind of windows where we can make some very interesting bets with a 5 to 10 year view and horizon, on the lookout.
So let us take a look at your toolbox. So how do you arrive at this 30%? How do you measure them? And what is in your toolbox for the 30% return?
The toolbox. Well, look, it's analysis. It's getting into the companies. It's forecasting. So, every company we look at, and we're generally looking at Series B, C, that kind of area, and they'll have their own numbers and forecasts, from an individual company point of view. But, we'll be stress testing the hell out of that and their numbers out 3 to 5 years. If it's a realistic model, we'll work with it. If it's unrealistic, we'll build our own. But we're generally trimming and being more conservative than what they're being. And they should be aspirational. They're entrepreneurs. It's the game that they're in. Forecasting out in local currency, because these are all local currency businesses that we're investing in for the most part, be that Mexican peso, Turkish lira, Brazilian real, and deflating that when we convert into hard currency into US dollar, because the assumption is the currency will weaken over time. So maybe a currency deflator of 5 to 10% per annum, depending on the market. And then we're looking at exit multiples as we look 5 years out. We're looking at the peer group. We're looking at a reasonable peer group and an exit average multiple, over time for these companies. And that's the exit multiple we're putting on these companies. And then we're discounting it back to see if we can get, for the price we're paying today, what would be the price we'd pay today to get a realistic 30% plus IRR on our money.
So are there any qualitative factors in your 30% calculation? So is there any founder's premium because the founder is so good, or is it just numbers crunching?
It's numbers crunching, and we don't crunch the numbers if the founder isn't right. So the qualitative factors are what gets us to spend the time on the numbers, and we're not going to waste our time on numbers if those qualitative factors don't kind of work. So the founders, the VC, the space, the scalability, the addressable market, all that kind of stuff makes us want to do work, because Time is an asset, Tillman. We are a small team. Well, small and growing. We're nearly 10 people now. So we're growing as a team, as our AUM grows, as our business grows. But still, the opportunity cost of us spending any time on one individual company that we're not going to invest in is hard. So we sit down, once, twice a week as a team and decide where we're going to spend our time. We're obviously interacting with our IC, which is our board, about where we should be spending time, what they would or would not approve if we do spend our time. So all those qualitative factors feed in, and then obviously we're getting into the number side of things, which is, it's our strength, it's our history. I guess we came into this not as founders, but as analysts, as research people, as investment managers. A lot of people enter the VC world or private equity world as former founders, and everybody has a strength, brings something different. I think we've learned those skills and those muscles, but we brought a discipline on numbers, and I guess that's where we feel comfortable today, with markets obviously dislocating and share price falling. Did we get caught in the up cycle, and were we playing top of cycle multiples for investments we did just 3, 6, 12 months ago? I don't think so. I think we were very respectful with shareholder capital. We turned down deals which were wrong. We were playing true cycle multiples, albeit now we're at lower end of cycle multiples. So I think that's the discipline which served us well, or will serve us well, let's say that.
So in your calculations, what value do you address to options? With Creditas, you had them going to different verticals and enhancing their business. Is this something you factor in, for instance?
No, it's fair. Now, we forecast what we can see, Tillman. New countries, new business lines, we'll do this and that. And we've seen it again and again where companies say, we're going to go here, there, we're going to roll out this. And that's worth something. It might be worth something to them. It's not worth anything to us. It's nice to see. It gives you comfort that they're ambitious. But we forecast what we can see. We underwrite what we can see. And then we'll take whatever else on top when it comes.
So coming back to this idea of competition, and you already mentioned that you don't want to overpay and have a clear limit here, but is there also some impact of competition on your service side, so that you said VEF had to increase the offering it gives to founders, get more founder focused, get better in this? And is there any strength you want to add over the next years for VEF in this matter?
Yeah, no, it comes back to, and it's an interesting question, and we do think about this a lot, as in, one of our goals is to be the number one investor for the companies that we invest in. We obviously need to take care of our capital, which is our shareholders, take care of our companies. But if we are a top ranked investor in their NPS or their scoring internally, we will have a good brand and reputation in that market, be that Brazil, be that Mexico, be that India. And that will roll on to us getting invited to other great assets potentially to invest in. So I think first and foremost, you need to be supportive as a shareholder. We've learned that over time. You need to work with these companies in good times and bad. You need to provide capital and be a good supportive shareholder and tell them what you think at the same time. I think that's key. I think from our side, where our strength is, as I said, in numbers and forecasting and modeling, especially early stage companies, we stress test the hell out of their budgets and their models. We help them prepare for fundraising. We're very strong in capital raising, be that debt and equity. So we're kind of like an internal consultant or an internal investment bank for these companies. We don't overplay our hand. There's other funds that we partner with, which are very strong in different areas. The likes of QED, the ex-Capital One guys, these are very strong in data and asset quality. And the guys at Kazakh in Latin America, they're ex-Mercado Libre guys. They're great in scaling unit economics. They have real strengths in having built businesses from the ground up in that continent. And I guess if everybody brings their core skill sets to the table and a general wisdom set, then it benefits the company and the founders in their journey. So, we play to our strengths. We could add, what have we got inside a team? It is a team of basically fundamental analysts and investors. We could add founders to that, some skill set around that. And we haven't gone there yet, but it's possible.
What are the borders in your founder focusedness? So what are examples where you said you got some inquiries, but you finally said, we can't help you?
So a founder comes to us and asks for help in a specific area, and we go, no. Is that the question?
Or say, this is something VEF can't do. We would love to help you, but we don't have the capability to help you. So what are the limits here?
Exactly. Look, I guess there's an element of we shouldn't be telling companies how to run their business. We're the investors. We're investing in people who should have an idea how to run their business, where it's going. We should be the sounding board, the strategy. We should be the stress test, not looking to trip them up. And we've got investors like that, where I was in the US last week and we sat in a room with investors for an hour, for 2 hours, people like Fidelity, people like Ruan Cunniff, and they were stress testing us, being, slightly pushy, but it was for the benefit of us. So we'd walk away from that meeting and think twice about our strategy, what we're doing and aspects of it, so that they would benefit as shareholders. So I love doing that then with my companies, just, softly pushing them around a bit so that they rethink everything that they're going to do next, which I think they might have dug into. But as areas like skill sets, we will definitely, liaise with outside experts in tech, in credit quality, and connect people outside of our own company, but, skill sets and people that we know into our portfolio companies if we don't have that skill set. We'll never just give a hard no and go, no, we can't help there. It's always got to be some caveat of, let's see how we can help.
And where do you see your strengths in helping companies? You already mentioned that a bit in reference to founding rounds and helping companies to access more money.
Yeah, no, look, we do a lot of work on that area. I think it's important. I think, capital raising is key. It's key for the success of a private company. You can have a great company with strategy and numbers, and if the founder or founding team haven't got the skills to raise capital, and there's some soft and hard skills embedded in that, but it can be trained. So we work very closely with these companies to get their pitch right, their presentation right, to be presenting the right story in the right way. And that's a key area I think we focus on. And then introductions to anybody in our ecosystem, and they're warm introductions, because we wouldn't be introducing a company if we didn't rate it ourselves and putting our own capital to work in it. So I think that's kind of a forte for what we do.
So coming again back to the idea of competition, and what had the increased competition and increased demand for great companies has led to higher shares of passes for you, either because the company said we don't want you or the valuation was too high for you? How did the share of passings develop over the last time?
Yeah, no, it's definitely grown. It was definitely probably our peak year in 2021 on that front. But, maybe it's worth pulling back to the fact that we probably convert 1% of the deals that hit our funnel. So last year we looked at over 300 deals, and as a team, and that's from a first call right through to full due diligence. And sometimes things hit our process, and it's a 30-minute call, and that's it. It's logged in the system, and we move on. But to answer your question, last year we did 3 deals, I believe, and we lost 3 deals because of valuation. As in, we wanted to invest, we were ready to hand the term sheet, or did hand the term sheet, and somebody else turned up with a valuation higher. In one instance, twice as high. And in that instance, all you do is you call the founder and say, congratulations, good for you. You've got a bigger check from, arguably a bigger fund at a bigger valuation, less dilution. We were here to invest on reasonable terms, but, congratulations, and there's no disrespect, and it's all good. So I'd say 50% of the time last year. And before that, very seldom it happened to us, in 2017 through 2020. But 2021 was definitely busy on that front in terms of getting refused, Tillman. Yes, at the door.
What are the other reasons a deal in the end stage, besides valuation, didn't go through?
Yeah, look, if we get to that stage, it's because we've done everything on our side from a DD and numbers and, point of view that we want to do it. Legals is obviously a key area that can stop a deal happening. And to be quite honest, our chief counsel can veto any deal that we're doing based on legals in terms of terms. And because obviously last year and the last 18 months, as well as valuations and, competition going up, because the hotter companies and the terms start to get looser for the investors. So you're getting, a smaller stake for a bigger check. You're getting less legal rights. All these things start to loosen up at the top end of the cycle. But we haven't had it yet, but our chief counsel can very much step in and say, we're not doing this deal because the rights that we're getting here are not comfortable for us as a company and for our shareholders and the capital that we represent. So, it doesn't get there, just valuation, but legals can be another thing that just stops it at the last stage.
You know this chart very well.
I'm about to find out.
It's loading. it's the NAV price chart. And it's not the latest numbers.
Yes.
We have here, because like your share price is a bit down more and the discount to NAV has even widened from here. So this chart in mind, let me maybe ask a personal question. What does this do on a personal level? You do a lot of hard work, a lot of travel and so forth. But things run against you for a while on this market. And as an investor myself, I know it feels a bit powerless in this period of times. You do your work, you reposition yourself, but it's like the results, don't look that good. How are you coping with this powerlessness and maybe frustration, anger that comes up on a personal level? What are your hacks to stay focused and stay aggressive and don't lose the love for the game?
No, it's fair question. Actually, I'm very unemotional about share prices. It's a chart, it's a number, it's a data point. If you get into day watching of share prices and your own share price, you will go mad. I think I learned, long ago that the macro overrides the micro every time. So if Russia invades Ukraine and if growth stocks are out of favor, and if the S&P or Nasdaq is falling, who am I or VEF share price to get in the way of that? It's going to happen. I look at our history over 7 years and what we've achieved and what we've created and the position that we're in today. I look forward and I get more excited about dislocations and opportunities to compound value from here. Once we defend, and get everything on the front foot, as is key. I fully understand, well, we're all learning, but markets are, for us, they're a higher beta representation of our NAV per share. So our NAV per share may go gradually and generally up and to the right, but we see the share price, bounce around aggressively, as it does. Markets are efficient, sometimes overly so. They overshoot on the way up as we go to a premium. They overshoot on the way down as we go to a deep discount. I respect markets. I watch markets. They obviously impact us as a company, our valuation, when we can raise capital, what do we buy back, etc. Opportunities arise from that. But no, it's not. I don't get disheartened. I get out there like I did last week and I meet investors. I hold their hand. I tell them what's going on. I meet new investors and I warm them up for the next time. And we just keep on working. We communicate. We do things like this. We get out in front of investors. We don't hide. And over time, that will all take care of itself.
A lot of the next questions are a bit in the core, the concern of some investors who are public investors, that there's a disconnection, that I'm coming from the private markets and the valuations we see in the public markets. In the end, private market valuations will go down to the public market valuations. And for you, it is an important exit way to get money in where the public market again. So maybe what do you think is more true? With the current discount to NAV, Mr. Market is telling you that the IPO of Creditas, I think it's scheduled for 2023, but correct me if I'm wrong here, will end in a down round if they go public. Or Mr. Market is currently depressed and valuation should recover in the next 3 years to the levels you are showing with your NAV. What do you think is more true, or is there anything in between?
Look, I think the first point, so dislocations between public and private markets or vice versa. Well, what are we? We are a listed entity, so we have a share price. Who are our shareholders? Fidelity, Wellington, Robeco, Robur. As private market investors, we are as connected to the public markets as can be. So we're not a Sequoia or Excel or big, venture capital or private equity house, and that's no offense to them either. But we are very connected to public markets, and my history and most of the team's history is in public markets. So we've got a great understanding, respect, and we're always learning for public markets. So we don't live in a private market bubble where we believe that private companies should trade at 10 times what their public peers should trade at. We know there's a connect there. And we know when you're exiting, if you are exiting via IPO, private markets meet public markets and reality kicks in eventually. So you always need to keep that in hand, and that's how we value companies on an ongoing basis. So that's just one aspect, saying it from a general point of view. Then there's our NAV, and our NAV is made up of our portfolio companies and the valuation that we hold those companies at. And, we've got to respect the fact that share prices have fallen in global markets. And then within that, there's certain country share prices and there's certain sectors that, are key peers for the companies that we invest in. But what I've been talking to investors about is it's one aspect to a valuation in a company like ours. We have underlying forecasts and performance of our companies, growth of those numbers. We have local currencies, translating that back into dollars. So we take something like Creditas, and that's key to talk about because it is our biggest asset. They did raise money in Q4 of last year, and we did put capital to work in that. And one of our big investors, Fidelity, led that round. And they are public into private. They've got their finger on the pulse. Wellington, who are also an investor in us, took part in that round. They're public. So there's lots of public-private crossover, people knocking around the Creditas table. So there's not an ignorance of private markets. And then you look at some of the peers and the share price fall off year to date versus, say, Creditas, and maybe they've fallen 20%, maybe some have fallen 40 to 50%. But then I look at Creditas's numbers and they've grown 20% plus quarter on quarter in Q1. So the underlying growth in the story is supernatural versus peers. Then I look at the Brazilian real versus the US dollar, and that's nearly strengthened 20% quarter on quarter in Q1. So you've got these conflicting factors as opposed to, I see a share price of PayPal or Square, it's fallen 30%, i.e. your Creditas position is worth less. So, I guess that's what we talk to investors about. And we're very specific on each company that we look at, their individual forecasts and performance, the currency, tailwinds or headwinds, and in the peer group, whether it's marked to model or marked to the last investment round. And I guess what we've proven in the past, Tillman, is on the way down and the way up, we're very quick to change our valuation marks. In line with our auditors, our PwC, our auditors, we have an audit committee inside. Every quarter we sit down with them, we justify our valuations, and we wouldn't put out a NAV if we didn't believe in it. So our NAV, we obviously got our Q1 numbers coming, and that'll be a fresh NAV. And there will be some implications in that NAV, but those implications are more specific to what's happened in Russia and Ukraine because we've got a Russian asset, we've got exposure to the region, and they will be impacted, i.e. you put a zero on them when you work your way back. It's a small part of our portfolio, and we're very public in communicating that. But in other parts, we've seen some benefits of the ripple effects from the regional conflict, and I think Brazil is one of those positive ripple effects on what we've seen in the currency.
So some investors also feared and brought the questions looking at what Tiger Global did with the down rounds. Do you see any risk of this for you in a substantial way? Or how do you observe this down rounds that are happening?
It's going to happen. I don't mean it's going to happen in our portfolio, but it's going to happen across the board. I think what you've had exuberant private markets for a very long period. And all kinds of companies have benefited from that. Weak companies, average companies, and great companies. And valuations have benefited from that. And now we're going into a period where capital is, I won't say totally risk off, but more risk off on both sides of the fence. And we're seeing that in later stage rounds already. And people are going to pay less for companies if they do pay. We're going to see companies failing. That's going to happen. We're going to see down rounds. Down rounds could be a good outcome for some companies versus failing. And then, as always, we're going to see quality. It's a bit like buying a house. The quality house still gets the most bids and the premium pricing. So I think what's key for us is that we think and we believe we've paid the right price at the right time for these companies when we did pay for them. They've been growing since, and mainly we're heavy in Brazil, as we said, but also Mexico and India, which is good kind of real estate in emerging markets right now, given all what's going on. None of our big companies need to raise money this year, so they're not going to get involved in markets. And, we've raised a lot of money for Creditas, Konfio, Jumo, TransferGo, JustPay. Our top 5-6 companies have all raised significant amounts of capital last year. Don't need to touch these markets this year. And then we'll see what happens as we roll into next year. And all will be growing at very healthy clips this year, given all we've seen so far. So as we stand here today, I'm very comfortable with our NAV. I don't see the issues in our portfolio, but this is a crisis, Tillman, and these crises have legs, and they have ripple effects. So you kind of size what happens in Russia, Ukraine, in the region. Then you get the ripple effects into macro from food and commodity price inflation, positives and negatives. Globally, we're going to see a slowdown. All eyes on the US, what happens next on interest rate policy, and that ripples through everything else. So very much it'll be a quarter-on-quarter NAV evolution and watching that space. And it'll be micro-level companies as opposed to sweeping general statements. They know everybody needs to cut their NAVs, or it'll be like a specific company somewhere. But then you get beneficiaries, as well. On the other side, we can't negate the tailwind of the currency in Brazil. We can't negate the tailwind we're seeing with rupee and gold prices in India, or with TransferGo, which is a remittance company for migrants in Europe. And all of a sudden, we got the mother of all migrant moves in Europe because of what's happened in Ukraine. So I'm not talking about benefits from war, but it's very clear their business is and will benefit. So, we'd be looking at everything on a micro level, but it's defense first at this point. You make sure everything is shored up, you make sure everything is well funded, and then NAV then kicks in and valuation.
If you already at this topic, maybe let's try to take a look on the macro impacts on certain companies. You already told some stories. What other stories are interesting to hear for shareholders?
Yeah, look, it's everybody gets the macro playbook out, and there's some great economists out there, and there's some countries that are just built for these kind of windows. They got great, very strong balance sheets. They're commodity or food producers, and I guess we're quite lucky to have over 50% or nearly 60% of our NAV in Brazil. We just did 2 more deals in Brazil this year. So we're very heavy in Brazil, and we didn't do it for macro reasons, but obviously macro is helping them right now and helping us. Then you look at places like Pakistan and Egypt. We're in Pakistan, we're not in Egypt, and both of those countries have weak balance sheets. They're going to see, pressure on the current account. They're going to see or need help from external parties, be that the IMF or bigger, wealthier nations. They'll probably see their currency devalue to a certain degree, and that puts pressure on those local countries, and they'll keep capital away in big amounts for a period. So, it's a real country by country approach. I think Mexico is somewhere in between. I think India looks good geopolitically and has a stronger balance sheet than it ever had. So I'm actually quite happy given where our portfolio is today. And I guess if we looked back 5 years ago, we were very heavy in Russia. That's where you don't want to be long today. And we've exited that. We made good money for our investors, and we redeployed that capital into different geographies. But, that's a different story. But yeah, I'm quite comfortable from a macro geopolitical thesis of where our portfolio is placed.
Maybe you can tell us a bit more about the impacts you see on Brazil and why it is a positive for the country, the current situation, or that positive?
Look, let's not get too carried away. I'm not saying, I'm living in dreamland and Brazil is going to, go to the moon while the world falls apart. There will be a global macro slowdown as a result of what's happening. The ripple effects will happen everywhere. We've seen inflation pick up even in Brazil, and now interest rates are at double-digit levels. So, I see it on a micro level through Creditas, where it grew its loan book 3x last year in 2021. That's public information. Will we grow 50% to 100% this year? That's more reasonable in an environment like this for a story like that. So, it's not the year for everybody to go gung-ho on growth. It's the year for a little bit more conservatism, I think, across the board, while still seeing solid growth in most companies. But I think Brazil, it is food, it is commodities, oil, gas, etc. That's obviously key for Brazil's exports. That's feeding through to a stronger currency, as well as the high interest rates in the interest rate trade versus the US. And it's a nice, very nice tailwind when you've got assets in Brazil which are 100% Brazilian real, and you're investing with hard currency. You don't expect it, you're not forecasting it. That's not what you're looking for from a micro level, company. You're looking for them to compound and win their space and to exit. But if you get tailwinds along the way, especially when there's a lot of stress in the world, you take it.
Interesting insight into Brazil. Do you play an instrument? Music instrument?
I do not play an instrument. I would have tried guitar over the years, but I failed miserably. So no, I don't play music.
Then maybe let's do it with the keyboard picture or the keyboard metaphor then. So if over the last years, or I think last 2 years, you saw a bit more playing on the instrument set or the keyboard set of capital allocation and capital raises, and now with the bond you made something. Maybe walk us a bit through what do you think about capital allocation, distance, capital raises, also in this environment with the high discount to NAV?
Yep. No, it's fair. Look, I think we've done over the 7 years that we've been existing, we've done a little bit of everything in terms of, on the capital front. We started off with a rights issue. Then we had an exit from a public company, which is Tinkoff. We had an exit from a private company, what was EasyCo. And we've done 2 directed placements. And now we have issued a bond, our first bond, and a social bond for sustainable finance. So, very key kind of marker on our ESG footing. So, we've kind of stretched our wings in terms of how we attract capital into VEF, and we're very grateful for the various pockets of capital that have come our way. And we did a bond this time specifically because of what you said, Tillman, because of where our share price is trading. It's trading at a deep discount to NAV. And it's the window where you'd be buying back your shares, not the window where you'd be issuing your shares. And we're very aware of that. Hence, the bond framework was there for us and the capital support was there. And we were low on capital. After Q1, we ended 2021 with $62 million of cash capital. And following investments, we were below $30 million at the end of Q1. So we needed to replenish that capital and just be in a stronger capital position given what's coming down, or what potentially is coming down the path in terms of either risks and headwinds, and you want to be able to support your companies, or opportunities because of those risks and headwinds and new companies. Hence, we wanted to replenish. What I would say is we will probably raise more capital in the future, and that'll be a function of our share price. And would it be a rights issue? Would it be a directed placement? We'll see, and we're very open to both. We touched on Creditas earlier, and I actually didn't answer your question about IPO and exit. It's still a company that wants to IPO. It will be IPO ready this year. And they're very clear in communicating that to the market. But, will the markets be ready for them this year? Probably not. They'll more likely no than yes. So it's a 2023 playbook. And that's where we can see more capital potentially coming in, where it's a name we'd like to keep for longer, given everything we know about the company, but it's also potential for us to take some capital off the table. And we'll see when that journey comes around. So I think exits, equity placements are still very much on the table. The bond gives us nice breathing room and capital comfort. And then there's obviously the potential to buy back our stock, something we can't do right now, unfortunately, because of our Swedish holding company and the fact that we're listed on Nasdaq First North, which is a secondary exchange in Sweden. But the important thing for us and for our shareholders is we're moving to the main board. So we'll be on the main Swedish stock exchange is the plan. Everything goes according to plan in the next 3 to 6 months. And there's lots of positives within that, but also within that, we're allowed to buy back our stock again.
What are the other positives that are coming from this relisting?
Well, we're on an unregulated exchange. So even though we act and operate like a regulated entity, given our shareholder base and what we do, officially we're on an unregulated exchange. And that keeps certain pockets of capital away from your share. You move to the main board. It means you're open for all pockets of capital globally. We like that. It takes away some of the minimum thresholds that people can hold in your stock because you'll be regulated. And it also comes with more fund flows and more eyeballs from retail and tracker funds, etc. So it just means effectively you grow up as a company, you're on the main board, and you've access all areas for capital as opposed to certain areas.
You already mentioned cash, so maybe how do you think about cash inside of VEF? Is it something you want to hold to a certain extent to be able to be aggressive in volatile phases? Or is it like Dave has his telephone in his hand and he's always able to call some of the core shareholders and say, maybe we need you to, via a bond or a capital raise, to give us cash to be more aggressive in this phases? How is it going there with cash?
The magic phone, make some calls, get some capital. Look, it's a balance. So we would like to be light on capital and then just call capital as and when we need it, i.e. via equity or via debt. But the realities of the situation is you are a slave somewhat to markets. And when markets are poor, like they are now, your share price trades down like it does. And it's more difficult because your shareholders are also having difficult times and they're seeing lots of opportunities to deploy capital, or maybe they're playing defense as well. It's a bit perverse when times are good and everything's fully valued. There's more capital on the table to play with. So I guess the way we think about it is we like to keep enough capital to be strategically flexible in what we do, but not too much capital that we're going to hurt overall performance. But there's a bit of give and take in that tussle. I think we got too low on capital in Q1. I think now after the bond sitting on $70 to $80 million of capital or cash capital and about 10% of our NAV, it's a good place to be. both, for downside protection, upside flexibility, and not too much drag on performance. So I'd kind of like to keep it, give or take, in the 5 to 10%. Closer to 10% would be comfortable from my side.
It's an interesting insight. Let us move on a bit and look at your core portfolio holdings. And I want to focus now on Creditas and Konfio. Maybe you can walk us a bit through the investment thesis behind these companies. What value do these companies add to the customers? Why are they growing so strong?
Okay, look, let's start with Creditas, our baby. It is over half of our NAV, and if you want to know about VEF, you want to know about Creditas, and if you like it, you go a long way to liking us. And it is a special and unique company in that what they do in Brazil, which is a scale market, is they provide secured consumer lending. So Brazil is a very large consumer loan market. It's about a $500 billion existing loan market today. So it's not like it's one of these emerging markets with future potential growth. It actually exists. The problem is a lot of that lending is unsecured lending. It's credit card, it's overdrafts, it's personal loans. So it's high rate, short duration loans to individuals in Brazil, where a lot of these rates can be as high as triple digit annual or double digit monthly rates. So it's what Creditas then does is it provides a better product market fit. It's providing a secured product, secured against your home or your car or your payroll. And once there's security or collateral against it, they can charge you a lower rate than the banks do on average, and a better duration. You can get a longer duration loan, more fit for purpose. So I think it started with that. It's not that banks can't do this product or don't do this product. They just don't push this product because their core unsecured loans, are much more monetizable, better unit economics for the banks. So Creditas pushed this product, and it's a product that exists in Western Europe and the US, and it's very deep and rich, but they were kind of pioneers of it in the Brazilian market. And they've been doing it for over 10 years now. And because of the size of the addressable market, they've just been compounding from a $50 million loan book to 100 to 200. As of today, it's an $800 million loan book. Sorry, this is as of year end at 21, and this is public information. And the way they built this business is they fund it all off balance sheet. So it's an off balance sheet funded model locally, all local currency, all matched, into a scale market with a great product market fit with supernatural unit economics. And they've proven they can scale the team, scale the product, scale the volumes. And what's happened then over the last 12 to 18 months, as they've gone through each of those ecosystems, home, auto, and payroll or work, they started to roll out more products, whether it's insurance, in payroll, into benefits, auto, I'd say insurance, but auto iBuyer. So that, you're getting different product suites into that core relationship and doing partnerships with some of the big entities in the fintech scene in Brazil, like Nubank, as they cross-sell their products into their client base. So it's been a very exciting journey where they're really delivering on a scale opportunity, which is the core. That's got lots of room to compound. And going back to my earlier point, you can forecast the compounding nature of that as they have the capital, the funding, the product market fits, and they're just improving incrementally as they go. And it's a very strong team. And then they're expanding, broadening and deepening the TAM as they go. So that's what, the more time we spend with Creditas, the more we like it. Hence, we've given them more and more capital over 4 rounds from Series C when we first invested back in 2017, right up to their Series F, which was done in Q4 last year. Hence, it's very hard to find a story like Creditas, like a Tinkoff for us in the past or an EasyCo. And when you do find them, you get close to them, you sit on the board, you see what's happening, you have an inside track, you just get as much capital in as possible and enjoy the ride.
And maybe you can also explain a bit more on Konfio, like what value do they add for the customers? Why could they grow so strongly?
Yeah, no, it's fair. Look, different. It's Mexico versus Brazilian stories talked about, but still a scale market. There's 130 million people. But where do Konfio focus? They focus on small businesses versus Creditas on the consumer side. And what you've got in Mexico, and why we like the small business space in Mexico, is because there's 7 million small businesses in Mexico, and the banks just don't service them. So this is more about financial inclusion and under penetration than the banks treating them badly or having too high prices. So if you are a big corporate in Mexico or a rich or middle income individual, the banks will take care of you. So it's very good banking for the top end. Then at the very bottom end, there's kind of microfinance or do-gooder institutions. So there's a lot of kind of focus on that. But in the middle, small businesses, and obviously, Tillman, you're from Germany, which is the home of the small business. There's just no small business banking going on. And we're talking credit, for one. We're talking payments. We're talking software for management information systems. We're talking just basic banking products. So Konfio started, once again, like Creditas maybe 10 years ago, focusing on credit, working capital for small businesses. It built out that product. It was rolling, it's scaling it, still scaling it today. And then it moved to product number 2, which was ERP, zero model or into a QuickBooks for small businesses. Then the third product, it made an acquisition last year in payments, like merchant acquiring, like the Square model in the US or iZettle or SumUp in Europe. And now it's applying for a banking license. So effectively, it'll be a digital bank with a full suite of services for the Mexican small business. And that's what they've been building. And the interesting thing is we're shareholders in Konfio with much of the same shareholders we are in Creditas. The two founders know each other very well. So there's a lot of kind of cross-pollination and ideas sharing in those two markets and those two businesses. I'd say Konfio is probably running about 18 months behind Creditas. Not a negative, but just in terms of size and shape and stage of its journey. Whereas Creditas is, IPO ready or thereabouts. Konfio is a little bit behind, just given its traction and its type of journey versus what Creditas is.
Very interesting. Let's do some more deep dive on Creditas. So what can shareholders expect from the cooperation with Nubank that recently was announced? And maybe you can also explain what Nubank does for people who don't know Nubank in Brazil. Hey, Tillman here. I'm sure you're curious about the answer to this question. But this answer is exclusive to the members of my community, Good Investing Plus. Good Investing Plus is a place where we help each other to get better as investors day by day. If you are an ambitious, long-term oriented investor that likes to share, please apply for Good Investing Plus. Just go to good-investing.net/plus. You can also find this link in the show notes. I'm waiting for your application. And without further ado, let's go back to the conversation. In your presentation, you disclose some key metrics for Creditas. Maybe let's take a look at them and maybe help me to understand the revenue side and the net income side of Creditas. Maybe let's begin with the dummy question. Why is the net income for Creditas like the loss is growing year over year over year? And how should I understand this loss? It's a dummy question, but yeah.
Yeah. No, you don't want to extrapolate that. Look, what you got a company in fast growth mode. And the top right chart is the revenue, and this is all public information. So this is their quarterly revenue, and this is all in local currency. So this is Brazilian real divided by 5, give or take, to get your dollars. So it's a company that's very much growing on the origination side, on the left-hand side, and on the revenue side. Its unit economics are strong, such that on a contribution margin level, they're profitable, and where they are break even before effectively customer acquisition and expansion. So where those losses have been racked up is effectively a function of them aggressively expanding. There's been a whole new raft of M&A and expanding into new countries like Mexico. And mainly it's the customer acquisition spend, where they're spending incremental dollars to bring customers through the door. Now, every customer at Creditas is a paying customer. So once they come through the door and they spend money to acquire that customer becomes a 1-year, 2-year, 5-year customer on a revenue product on a secured loan. What we've done in the past, and you see kind of blips of positivity in that kind of negative chart for net income, is where they stopped. They say, let's stop acquiring. And what it shows is the core business is profitable. And that's, this is all spend for future growth. And what you're going to see starting to happen through 2022 is that chart to start to tear up. And because we're moving towards IPO, the growth will be less. The machine is scaled now. It's to say $800 million in Q4 of loan book, which is paying, and there's fees being paid on top of that. So you're going to start to see the trend going back up and to the right towards that kind of break-even point, because the markets want, and they should want, a company that's not only strong, growing with a big addressable market, but also one which is a path towards profitability from here. And Creditas at its core is unit economic positive, but it's that expansion and that kind of customer acquisition, which is the reason for the burn.
What are the key costs in this customer acquisition? Like, where does Creditas spend the money towards, and how efficient are they in your eyes?
Well, the good thing is they're getting more and more efficient. So the direction of travel on customer acquisition is improving quarter on quarter, almost for the last, I don't know, 12, 16 quarters. It just continues to trend down in terms of what they pay for a customer. I won't get too much into the specifics of the numbers, but if they're lending $100, they will be taking 30% on average of that as interest income over 1, 2, 3, 5 years. So 30% a year off the top from that. What they pay up front to acquire that customer can be 10%, can be 20% of that loan value. So upfront is a very meaty amount of customer acquisition costs to pay, but then over the life of the loan, you more than get that back in the return, and the capital return is very high. So hence you have the upfront customer acquisition costs are quite high, but they're getting more and more efficient as they grow.
And how do you make sure that the loan doesn't default over time, and like they have the right customers?
Yeah, look, they have the right customers, A, and B, they have the right collateral. I think B is more important than A. And that's the beauty of collateral lending. And because if I lend to you, Tillman, and I give you $10,000, and I hope you pay me back because I score you because you got a good credit history. But if I give you $10,000 and you collateralize it against your home, which is worth $500,000, and if you don't pay me, I can take your house, it's very likely you pay me. So the collateral is important.
Yes. Okay. And maybe another dummy question, if you could look at the recurring revenue and upfront revenue chart above the net income, can you explain the term recurring in this sense and upfront?
Yeah, look, there's fees and there's interest income for Creditas, especially on the credit products. So the upfront fees that they get off customers for underwriting the loan, are upfront. And also the funding structures that they fund off balance sheet, they actually get paid for sourcing the loan and securitizing them. So there's a lot of fees that come up front. And then there is life of the loan where they're getting interest income, over the 1, 2, 3, 5 year period. So it's that mix. But what I would say, this is all Brazilian GAAP and local accounting standards, not to get too boring. We'll move to IFRS and there'll be different accounting treatments of all these things. And we're going to evolve that way as we move towards IPO. But I guess the way IFRS goes is you get more conservative at most things. You take provisions up front. You can take fees over the life of the loan. So it'll all be morphed and merged a bit as we go.
This episode is also a bit about fears of investors, and you already mentioned Tinkoff in our conversation. And if you look at this was once your largest holding, I think. And if you look at the share price of Tinkoff, which is a great company, they went from $90 to $3 at the moment due to the Russian invasion. And if you think about like the willingness in the emerging markets to underwrite like a huge concentration you have with Creditas, is this what you've observed now with Tinkoff a bit challenging your mind there and let you rethink sizing about a certain threshold?
Simple answer, no. And we're not reckless with investor capital, but we're not calling global geopolitics or, that's not our mandate. Russia is special in that regard. Russia has a tendency to go to zero every so often. In some way, it has a tendency to, I've seen it so many times, so many crises in Russia. This one is different. They're all different, but this one has a darker edge to it, and we all know that and very aware of it, and the ethics are pretty negative there. But Tinkoff is a phenomenal asset and a phenomenal business, arguably one of the best, if not the best, digital bank or fintech in emerging markets. Nothing that Russia's done has changed that fact. It was built by an entrepreneur, not an oligarch, built from scratch with a very strong team, loyal, hardworking, skilled, who have been with them through the journey. Revenue first, unit economic first, profitable first. Nothing's perfect, but they are as close to perfect as you get in the EM fintech world. And what's happened to them is a function, obviously, of what's happened on the war front and with Putin and the invasion in Ukraine. And you said it's trading at $3 a share, but it's trading at $3 a share and not trading, so it might as well be worth nothing, albeit it is very much a going concern. So what does that say to me? These things can happen. Of course they can. They're more likely to happen in certain emerging markets, i.e. Russia, than others. We don't mind concentration though. I'm very happy with our Creditas concentration for all the reasons that I said. But there will be a time when, we'll be out of that and something else will be concentrated. And we were heavy Russia in the past, and we were heavy Turkey. Today we're heavy Brazil. We're looking at India, 3 investments and growing. We're looking at doing our first investment in Indonesia. So we keep on evolving as we go and as we grow. But yes, we have to be very aware of what happened in Russia. And we did a lot of soul searching after we exited Tinkoff, effectively at $17 a share, and watched it go to, as you said, $100. And we asked ourselves, did we miss a trick? We knew the company well, arguably best. We were on the inside, it was compounding, and we left a lot of money on the table. But now it's worth nothing, and we look clever. So yeah, the truth's somewhere in between.
Are there any other lessons you've taken or learnings you've taken from this impact of the Russian invasion to Ukraine and what has happened there for your investment style and your approach? You have some impacts in the portfolio. You can also explain them if you want, but it's more about the lessons and if you've changed anything in your process and thinking.
Yeah, to be honest, no. And that's not saying we know everything or we're not learning. We're learning lots always. It's an I've been around a lot of Russian and Russian related crises in my life. And it's the first time it's happening and I'm not brutally exposed to it. So we have a very small exposure. Revo, buy now, pay later company in Russia, very good company, growing, profitable, but it lives in a parallel universe right now. And we'll see where that universe goes. So we're very able to shape our exposure to the region, very able to look through to the global aspects and ripple effects of that. But now, lesson wise, I don't think we're looking at this and taking anything away. If anything, we're questioning, can we invest in Russia again? That's a question, ethically, fundamentally. I think we sit on that one for a while because obviously with our structure, our long duration, arguably there is an opportunity for us to put capital to work in Russia. Maybe not. And these are questions that we're asking ourselves and asking our investment committee and talking with our shareholders. So these are things we're thinking about, but I don't think we've taken any real hard lessons from this so far and look to change anything that we do.
Let's go back to Konfio. In your annual report, you have written a quite interesting sentence. Konfio now has all the pieces of the puzzle in place to grow into a multi-billion-dollar company. So why is that?
First of all, it's easier said than done. Second, you can have all the pieces in play, you still need to execute. But why is that? I think it's a function of when we invested in Konfio, it was a monoline. It was a single product company focusing on working capital to small businesses. And their promise to us when we did invest was that they would keep on focusing on that while adding in more product suite. And they have added in the payments, they've added in the ERP, they've added in, hopefully soon, a full digital banking license for the company. And that means it can be the #1 small business financial ecosystem in Mexico because they can offer everything to the small business in financial services. Now, the key for them is execution. They need to take the sum of the parts and put them together and make it a valuable whole. And that's their kind of, so, that's where we sit around as a board and as a management team. And when they look to bring all those products together, when they're talking to small businesses, so they can offer the full offering. So that's why it gets very exciting. But this is where it gets a bit more, this is where the work is done. Everybody likes to talk about acquisitions and raising capital. But sometimes your companies need to put the head down and really deliver. And that's the window that Konfio are in right now.
Looking at these 2 companies, but also the other portfolio companies you invested in, is there anything that has surprised you over the last year, or are there any super interesting learnings you want to share with us?
Like there's always learning, so we keep on learning. But specifics, I guess the importance of strong founders is always key. And I keep on, as much as companies and numbers, we talk about being analysts, founders make things happen. They make capital come through the door, they make good hires. So, we keep on seeing that with some of our founders where they keep on, impressing us on that front. And that's a key. So founder first, founder centric, get the right founders, then start thinking about everything else. That's always the way. I think we talked about it earlier, it's just not getting caught up in euphoria of markets and pricing, because as always, it turns. And it's turning again, and it'll turn again, and we'll get into a new cycle of fun. I'd like, I'm not saying we're the cleverest kids in the street and we knew this would happen. We were putting capital to work last year, but we think we put it to use at good valuations. But it's there. And I guess the last thing companies, investors, we've got some great investors. And it's just great sitting down with the Fidelities and the Wellingtons and guys at Ruin Cunniff, who are one of our biggest shareholders. And you talked about our share price falling and different negative aspects of any cycle like this, but this too shall pass. It always does. And you got to be sitting there on the other side of this. So you play defense first. You make sure you're strong, you're positioned, and then you start thinking about the opportunities. Hence, we raise money via the bond, putting more capital to work so that in 12 months or 24 months or 3 years' time, you look very good and clever about what you did in this window, as opposed to sitting back and worrying about your share price in the short term.
So a quite easy question on your portfolio. What will be the next Creditas in your portfolio?
The next Creditas. Look, we talked about Konfio already, but I think one to watch if you're a shareholder in VEF is JustPay in India. Just because it's a phenomenal company. It really is. Very strong engineering product first team. They got a great product market fit with what they do on the payment space on mobile first, mobile only. The partners that they have and that they're attracting from a customer point of view, from the Ubers, the Amazons, the Olas, they're letting their technology inside their app, and they're compounding with these companies and doubling year on year, and also rolling out new products which are higher unit economics. So we've got a team on the ground this week in India with them, sitting down, catching up on everything. If I was a VEF shareholder, obviously do your work on Creditas and Konfio. That's where the juice is today. But next gen is JustPay.
And who will be the next Konfio?
Look, you could probably go down to the earlier ones and the younger companies.
Or which companies are you like where you say that makes me bullish? Like it's hard to say. It's like you have 15 kids and you love all your 15 kids, but this kid has such a great talent.
I know. I've got 3 kids and I've got favorites all the time. I'm not ashamed to say it. But our newer investments, it's hard to get away from the new ones. So Abby, and I'm wearing Abby's t-shirt here. Just back from Pakistan. Energized after spending a week in Pakistan with them. And they are a phenomenal company in the financial wellness space with a great founder. Will raise more capital and will compound a lot of value for us as shareholders. So I really like that one. And then we did a deal in Brazil in Q1, a company called Gringo. It's a car app, growing like a weed. Great customer market or product market fit there. Great unit economics, and how they process payments for all aspects of a driver's needs in Brazil, be that fines, registration, certification. It's kind of a hidden niche, but a scale niche at that. I've got a couple of other interesting deals coming down the pipe. So you can't help but getting excited too much about the new ones. It happens. But as an investor, I'd stay focused on Creditas, Konfio, and JustPay, and then let the rest kind of season a bit, and they'll come through nicely.
A market where you're just laying groundwork, I think. You haven't announced any deal is Egypt. And you said in your report you like a lot what you see in coming out of Egypt. What could you observe on the ground and why did you like it?
Yeah, look, it's, I hate to say like 100 million people, and you kind of hear people saying Pakistan, 200 million people. It's a very simplistic terminology, but it is a scale African or stroke Middle East market. So that gives you, and we like single country plays because that's where you get the most juice. It's when companies cross borders, it can get more and more difficult. They have a nice tailwind from a regulatory point of view and government point of view and digitization. So the direction of travel seems to be somewhat akin to what we've seen in markets like India or Brazil, albeit earlier stage. And we're getting a local ecosystem of venture capital funds seeding companies for seed and Series A. So we're starting to get the ecosystem, the capital, the regulation, the governance, and obviously the population is hungry for this. So that all feeds well. I think what's less well is just, unlike Pakistan, where we've done 2 investments, about to do 3, and we haven't yet found the company or the founder we want to back yet. That can change very quickly, but it's a function of finding that before we put capital to work more than anything else. So, I'd say we are open and happy to invest in Egypt, and we need to find the right opportunity.
What is your playbook to open such a market for you? Or if there's any playbook?
No, there is a bit of a playbook, and it kind of, people ask us how can we sit here in Europe and do what we do, but it doesn't take a lot.
There's this internet.
It is this internet. But look, we've got a reputation and a brand for EM and fintech. We've got relationships across the globe in the VC world. We travel, we hit the ground, we learn the public side, from the government, from the macro to the politics, to the listed companies, the banks, the telcos. In Egypt, there's a company called Fowry, which is kind of fintech 1.0. You get inside that. You travel on the ground, you meet the local VCs, you meet the entrepreneurs. And because there's so few people doing this like us, it doesn't take a lot to become the global expert in Egyptian fintech. Now, the competition is very small because not a lot of people dedicating a lot of resources or time to that, other than the locals or the regional guys. And then you become one of 5, one of 10 people looking in depth at that market, having a resource with their finger on the pulse, looking at that. And then you find the founders that you like and the spaces that you like, and you drill and you dig, and then opportunities arise, and you try and take them.
Very interesting. For the end, I want to talk a bit about climate risks, because you tend to concentrate on countries that are close to the equator, where you already have a lot of heat and humidity, and you see impacts of climate change stronger in my eyes. How are you thinking about climate risks with the investment process you're doing?
Yeah, I don't get asked that question every day, to be honest. From an ESG point of view, we're very, not that we're ignorant on E, and obviously G is a given we're a listed entity in Sweden. We focus a lot on S, and sustainable finance and financial inclusion and wellness. So that's kind of been our strength, and hence the bond that we raised. From an environment point of view, obviously there's individual thoughts on that, but from an investor point of view, we're not exactly investing in that, albeit we do have a very interesting deal done in the making, was announced in our annual report, but we haven't formally made a lot of noise about it, where we're going to invest in a solar company which lends against solar panels, just because of the climate aspects of Brazil specifically, and the opportunity in that space and the credit behind rolling out that product. So I'm not saying, Tillman, we're ignorant of it. I wouldn't say we're overly focused. This is throwing up some opportunities, and we need to take advantage of them. And we need to have a strong ESG playbook and watch our aspect of that. But no, I haven't seen it come to the fore as issue number 1 in the countries that we focus on.
Do you fear any impacts of climate risk at a certain point on your portfolio, that certain regions will have problems accessing capital markets, migration as a topic?
Maybe. Like, migration as a topic is very real, but I'm trying to get my head around where the world migration flows are going. I think poor countries to rich countries is a bit simplistic. Africa to Europe, and that things are changing and evolving all the time. Mexico to the US, maybe it's going backwards within that. So migration flows based on climate as well. I think it's a global thing as opposed to an equator-based thing, and it's developed markets as well as emerging markets based around that. I think it's everybody's issue. So I don't think it's a totally thing for the markets that we look at. But as you say, some of them are front and center in that. They've probably got more priorities at their level. Not saying they shouldn't, but in terms of poverty levels and getting everybody up to a certain level and standard and basic needs. But they need to be part of the global climate debate with the Western world as well.
Yeah, the background I'm asking these questions is also that I took a deeper dive into the climate topic, and did also look at the countries around the equator, and I think there we will see the biggest impacts in the next years. For instance, in Brazil, I'm personally I find it generally super interesting what you do with enabling people to participate in financial service, which is for a Western person normal thing. You go to a bank or you just like go online and get an account and everything is fine. But a lot of the emerging countries have problems with the services, and you do a lot, and it's also the reason why you could do the social bond. But on the other side, for instance, if I think about Brazil, Brazil has a lot of energy dependency on water because they have a lot of dams through the Amazonas. Amazonas is, with every degree of warming and every quarter degree of warming, it's getting drier and drier. So the question is where this water comes from for the energy productions. You have dependence on coffee production and exports, soya. It's also a question with jet streams destabilizing. You had this, I think, last year, snowfall, coffee plants coffee dropped by 25%. You have, if you think about Egypt, you have the Cairo and all the concentrated around the Nile River. And if sea level rises, Alexandria, I think, I'm not 100% sure, will have pressure. You have India, where you have these heat days that are so hot. If you're standing in the shade, you have the risk to die.
You have gone down a rabbit hole, haven't you, Tillman, on this one?
Yeah, it's nothing like. I'm a bit fascinated with this focus on emerging markets, how you can assess these risks, because like what I personally worry and is that for certain regions at a certain point of time, people will say, I don't know enough and I can't land there anymore.
Yeah. Like, I know you've got these long-term climate risks and not the only ones, and you got the short-term geopolitical risks. We talked about Russia, Ukraine, and then you got political cycles in these countries. We've just seen Imran Khan being ousted in Pakistan. We got a Brazilian election. All these short-term focuses when one should be pulling back on the long-term issues that you talked about on the climate side, globally, collectively. So, we can't be ignorant of it. I don't think it stops the capital flows today or the capital exits today. But it is we won't have to be cognizant of it and more as we go. But I do think on the energy side in Brazil, and you did point to the water factor, it's very key. And that was part of our kind of thesis about investing in this solar lender, because Brazil is made for solar, like Australia is made for solar. And I think 25% of Australian power comes from solar. The penetration is pure there. In Brazil, it's 2%. And just the demographics and the aspects are, very similar. So that's where we're looking at a playbook on that, which would be good from a climate point of view, or just from an energy point of view. But the climate side needs to be fixed too.
Then thank you very much for our interview. For the end, is there anything you want to add we haven't discussed?
No, I think just wrapping up, Tillman, I think we've touched on a lot of topics, and one needs to be very realistic in the world that we live in today. Publics versus privates, geopolitics, ripple effects into macro. We've been here before, and we'll be here again. We're building something for the long term. We're investing, we think, in great companies at true cycle valuations. So when something like this happens, we don't really get caught off guard. But we think deep. We work with our companies. We get capital to work for the long term. So it's just another cycle. And we're not being blasé or too relaxed about it, but we're not freaked out by any means.
Then thank you very much for your openness, answering all the questions I had, and thank you for the viewers staying till now. Bye-bye.
Super. Thanks, Tillman. Ciao.
As in every video, also here is the disclaimer. You can find the link to the disclaimer below in the show notes. The disclaimer says, always do your own work. What we're doing here is no recommendation and no advice. So please always do your own work. Thank you very much.